As we've been following the economic trends, a fascinating story has caught our attention. It's about the relationship between wages and wealth in America. We've all heard the phrase, a fair day's work for a fair day's pay, but is that still the reality? The data suggests that workers are getting a smaller share of the economic pie, while owners of assets like stocks, real estate, and businesses are reaping more benefits. This got us thinking, what can we learn from this trend? Is it time to rethink our approach to building wealth? We're not here to solve a 55-year-old economics debate, but rather to explore the implications for individual investors like you. If earning a paycheck is no longer the most effective way to build wealth, what are the alternative strategies that can help? We'll be examining various options, from investing in stocks and real estate to exploring alternative assets like gold and cryptocurrency. Our goal is to provide you with a balanced view of the opportunities and risks associated with each approach. One thing is clear: the traditional model of relying solely on a paycheck for financial stability may not be enough in today's economy. By diversifying your investments and building a portfolio that includes multiple asset classes, you can potentially reduce your reliance on any one source of income and increase your chances of long-term financial success. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We are exploring the latest developments in the world of technology and finance. Our middle segment today takes a deep dive into the recent news surrounding Alphabet, the parent company of Google. There's been a significant shakeup in their AI division, DeepMind, which has led some analysts to speculate that Google may be losing the AI race. However, others argue that this move might be a strategic decision by Google to prioritize AI diffusion over frontier model leadership. In essence, instead of focusing solely on developing cutting-edge AI models, Google could be betting on the economic opportunities presented by AI compute. This approach would involve providing infrastructure and tools for other companies to develop and deploy their own AI solutions. Alphabet's recent financial reports show a significant increase in revenue from their cloud computing division, with an 82% year-over-year growth. This suggests that the company is indeed shifting its focus towards providing AI-related services and infrastructure. The question remains whether this strategy will pay off in the long run. It's also worth noting that Alphabet's investment in SpaceX has had a substantial impact on their financials, with a $94.1 billion valuation as of June 30th. However, the decline in SpaceX's stock price since then may affect Alphabet's future earnings. As we analyze these developments, it's essential to consider multiple perspectives and avoid jumping to conclusions. The AI landscape is rapidly evolving, and companies like Google are constantly adapting their strategies to stay ahead of the curve. The implications of this shift in focus by Google could be far-reaching, with potential consequences for the entire tech industry. As investors and consumers, it's crucial to stay informed and monitor these developments closely. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at a pressing issue that's been making headlines in the financial world. We're talking about the potential impact of inflation on the stock market and how it could be influenced by a combination of factors, including government policies, global events, and technological advancements. A recent article caught our attention, highlighting what's being referred to as an inflation quadruple whammy that could potentially crush the stock market. This perfect storm of inflationary pressures includes the effects of tariffs, the ongoing energy supply disruption caused by the conflict in the Middle East, and the rising costs associated with the development and implementation of artificial intelligence. Now, it's essential to acknowledge that inflation can have both positive and negative effects on the economy and the stock market. On one hand, a moderate level of inflation can be a sign of a growing economy, while on the other hand, high inflation can erode purchasing power and lead to decreased consumer spending. The article suggests that the current inflationary pressures, fueled by the factors mentioned earlier, could lead to higher interest rates as the Federal Reserve attempts to stabilize prices. This, in turn, could have a negative impact on the stock market, particularly on companies with high levels of debt or those that are heavily reliant on borrowing to finance their operations. It's also worth noting that the rise of artificial intelligence is having a profound impact on various industries, and while it presents many opportunities for growth and innovation, it also poses challenges, such as job displacement and increased costs for businesses and consumers. As investors, it's crucial to stay informed and adapt to changing market conditions. While it is impossible to predict with certainty how the stock market will react to these inflationary pressures, being aware of the potential risks and opportunities can help you make more informed investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.